What's up YouTube, and welcome to today's video about Realty Income, ticker symbol O. This stock has been up almost 10% year to date, and if we zoom out on the 1 year chart, we see that it has been a roller coaster ride for this stock. But I'm planning to buy big time, and I'm planning to buy roughly 50% of my current stake, so increasing it a lot. And the reason why is that I think Realty Income is still looking undervalued at a price to FFO of only 13.5. On top of that, they pay a whopping dividend yield of 5.6% and have a stellar dividend growth. So without further ado, let's dive into the stock. So taking a look at the most recent earnings, we see that revenue was reported at 1.4 billion. Up from 1.2 billion year over year. Net income per share was at $0.28, increasing a lot year over year. But the most important number here is the FFO and the AFFO, both increasing quite decently year over year. And with FFO and AFFO sitting at $1.06, we also see that dividends are covered very easily. Currently, Realty Income pays a monthly dividend of 27 cents. So if we multiply that 0.27 by 3, we get to a total quarterly dividend of $0.81. If we divide that by 1.06, which is the AFFO reported most recently, we see that payout ratio is at 76%, which is the average for REITs, so that's already looking really good. And diving into the Realty Income Investor Relations, we go to the most recent net earnings release, where we see that Realty Income has an enterprise value of 80 billion. Currently, it has 56 years of operating history. On top of that, Realty Income reports A credit ratings, which to me is really important. And Realty Income is also the 7th largest global REIT with properties in 8 countries. Looking at the diversified real estate portfolio, which we get more into detail later in this video, we already see that Realty Income almost has 1600 clients and 91 industries. But more on that in a minute. Let's get to the second slide, where we see that Realty Income has a compound annual total return since 1994 of 13.6%, which is really insane and outperforming most other stocks and REITs in America. Looking at the dividends, we see that they have been growing really steady and consistent as well, at 4.3% compound annual growth rate. To me, this looks really good. And taking a look at the guidance, I get a little bit disappointed, where net income per share is a little lower than the previous guidance. AFFO is reported similar to previous guidance, and occupancy rate is expected to be at 98%. To me, this looks really good. Moving on to the diversified and high quality portfolio, we see that 7-Eleven is the biggest tenant with 3.4%. Followed by Dollar General and Walgreens Boots Alliance, and also Dollar Tree. So in here we already have a few companies that most people are really worried about for the future. Looking at the industry diversification, we see that grocery is the biggest with 10%, and I prefer a maximum of 10% here, so that's looking pretty good. Convenience stores is second with 9.9%. Dollar stores is third with 6.3%. Moving on to the geographic diversification, we see that United States is the biggest with almost 85%, but they are rapidly expanding to the UK and Europe. Looking at the property type diversification, we see that retail is the biggest with nearly 80%, followed by industrial with 14.4%. So what is really important for REITs, and especially in the case of Realty Income, is reporting a steady and consistent occupancy rate throughout the years, also during a crisis, as with COVID or the financial crisis for example. And we see that in most cases Realty Income reports 98% roughly. And that's looking really good, especially since the median of the S&P 500 REITs is significantly lower. Another really important metric for me to look at is the net debt to analyzed pro forma adjusted EBITDA in this case, which is reported at 5.4 times, and I prefer a range of 5 to 6.5. And again, the A credit ratings look really good to me. And now that we know a little bit more about this company, it is time to move on to the metrics that we see in Everythingmoney software. So starting off with the market cap. Currently Realty Income reports a market cap of 51 billion. Revenue is at 5.4 billion and net income is at 980 million. Taking a look at the revenue over the years, we see that it has been growing really steady and consistent. Most recent years, Realty Income really exploded in revenue due to mergers and acquisitions. And that's also reflected in the year-over-year growth, where in some cases they report 70% growth year-over-year in 2022. Most recently, it's more between 10 and 30%. Taking a look at the margins, I get really worried. They used to report really high margins, but ever since 2010 they are decreasing in margins, which is also a result of doing acquisitions and mergers. So this is something to keep our eye on. Moving back to the return on invested capital, we see that this is reported at only 2.2%, which is really low, and I prefer a much higher number here. But let's not forget, Realty Income is a REIT, so we accept everything above 5% in this case. Taking a look at the current ratio, we see that Realty Income reports 1.74 as of right now, which is a really good number in my opinion. And taking a look at their debt situation, we see that total cash is sitting at 390 million. Meanwhile, their total debt is at 27.5 billion. This means they are not capable of paying down a big chunk of their debt and could be a red flag in my opinion. But keep in mind, Realty Income is a REIT that tend to have more debt. And that's also the reason why they increase a lot of shares to raise capital. But more on that in a second. First, let's take a look at the analysis estimates, where we see that it is expected that EPS will grow steadily over the years. In 2025, they expect a 22% growth year over year. In the years followed, they expect to see 6 to 8%, which feels more realistic to me. Taking a look at the revenue, it is expected to grow at a really low number compared to historical numbers. For 2025, it is expected to sit at a shy 6%. 2026 we're looking at 5%, and 2027 it is expected to see less than 3% growth year over year, something to keep our eye on. Now let's move back to the shares outstanding, because REITs increase shares to raise capital. Usually I don't prefer shares to be increasing, because this dilutes the investor. But in the case of REITs it's a little bit different, since they are forced to pay out 75% of their income to the shareholders, so the only way to grow the business is to increase shares outstanding and raise capital. So actually this is something that doesn't bother me too much. Moving on to the dividends that we have talked about earlier, we saw that dividend yield is at 5.6% with an annual payout of $3.23. The 5-year growth rate is a little under 3.6%, looking really good. The payout ratio we saw earlier in the video was sitting at 76%, which is the average for REITs. The dividend growth is sitting at 31 years, which is insane for a REIT, and they have shown that they could handle stress during the COVID crisis, the financial crisis, and even dot-com bubble. Realty Income also pays a monthly dividend, which is really interesting for some people. Now let's take a look at the total return versus the S&P 500, starting on the 5-year chart and including ADC and NNN. We see that the S&P 500 returned 113%, massively outperforming all the others in this list. Realty Income is only sitting at 26.5%, while ADC did a little better with 33% and NNN did best with almost 55% return. On the 1-year chart things changed drastically, where Realty Income suddenly is able to outperform the S&P 500 with a slim margin. The same as ADC. NNN underperforms the S&P 500 and the others in this list with nearly 9%. On the 6-month chart it's the same story, where Realty Income almost doubled the return of the S&P 500. ADC underperformed and N also outperformed the S&P 500. On the 1 month chart, it's the S&P 500 again that is doing the best in this list. Realty Income is having half the amount of return, with 2.6%. Bottom line, I think in the past 5 years the S&P 500 outclassed everyone, and it is really hard to beat that return. But the thing is, Realty Income is in my portfolio because of dividend income, and not of stock share appreciation, so keep that in mind. Now, moving back to the Everythingmoney software, we want to see if Realty Income is a buy at current prices. So let's tick in the most recent price target that I created for Realty Income and see if it's still relevant. Revenue growth was really high in the recent years, but analysts expect much lower numbers, so we have to factor that in. So I think I still agree with previous numbers. The profit margin is decreasing over the years, so I also have to factor that in, hence why I still put lower numbers here. Free cash flow margin is also looking pretty good. The PE ratio is not too important for me, because it is a REIT, so we focus on the price to FFO in this case. Price to FFO is sitting at 14.37, so I think we did really well with the mid price target sitting in that range, and the low price target a little lower and the high price target a little higher. My desired annual return is still 12.5%, since the S&P 500 brings in roughly 10% annually over a longer period of time. Now let's take a look at the price targets. Based on the low price target, Realty Income has a range of $52.5. For the mid price target we're looking at $67.5, and for the high price target we're looking at $86. And as of right now, I think the mid price target is the most realistic one here. So we have a margin of $10, which is enough for me to buy this stock. Also because the dividend yield is insanely high. And with that we come to an end of this video. What are your thoughts on Realty Income stock? Are you planning to buy, expand or sell this stock? Please let me know in the comments down below. And thank you for watching. And remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only.